Demographics are the most influential factor for an economy. The real growth of GDP and the dynamics between inflation and deflation are all closely tied with the demographics. Let's have a look at the impact on each. So, to fuel GDP growth, you need to have more consumption. You can create consumption by either encouraging each person to consume more or by adding more population. However, there is a limit on how much a single person can consume. For example, we went from a common 2 meals a day 100 years ago to now promote 5 meals a day. The question is, how many more meals can we squeeze in a day? There is a limit to that. And people also start to wonder, is it really good for you to eat so often, or is it just good for the GDP, right? But with a growing population, the average consumption can in theory grow infinite. Consumption is just one side of the equation. To meet the growing consumption, you need to match with growing production too. This means we also need the prime working age population to grow at a similar pace to maintain the balance. The structure of the population, like the age and gender, will define the long-term outlook of an economy. The population of prime age, which is between 25 to 54, boosts the economy through the highest rate of income and consumption. They buy homes, vehicles, and durable goods. They also keep upsizing, like switching from a small condo to a villa and changing to new cars very often. This helps to boost the overall consumption. And because they are the primary workforce, they also boost production and employment. Conversely, an economy feels a drag when people over 65 comprise a larger share of the total population, particularly as modern economies are structured through government pension payments in retirement years. This means the majority of people stop producing after retirement, but they are still consuming. Although their consumption for goods reduces, their need for healthcare increases. The impact is net short of production in an aging society. This puts a lot of pressure on the working cohort. We hear a lot of developed countries planning to extend their retirement age further to try to cope with the shortage of labor. Japan is a famous example of an aging demographic, but not only Japan, most developed countries also run into such problems as the lifespan increases while the birth rate is low. For the past couple of decades, developed countries have been able to manage this situation through immigration and outsourcing production to other countries like China and India. But now, China is facing the aging demographic shift for the first time since the one-child policy. And the Western countries are facing growing problems with immigration. The next 10 to 15 years will bring a significant demographic drag, not only in Japan, but also in Europe, in the United Kingdom, China, and the United States. In this chart, we can see the aging population across major economies of the world. This is an inverted chart. So the 65-plus-year-old group as a percentage of the total population is increasing in the 5 largest economies. And look at China, the rate of increase is accelerating. In this chart, you can see the prime working age population actually declines sharply in China. This is a very worrying sign. Although the supply of labor declines from demographic aging, the demand for labor does not necessarily decline as much because retirees continue to consume. Retirees may purchase fewer cars and houses, but research suggests their overall consumption actually increases due to higher expenditures on healthcare. When a persistent demand for labor meets a declining supply of labor, then wages increases and inflation re-emerges. This is already happening as the pandemic kind accelerated the retirement decision, with many choosing to take early retirement during the past 2 years. In this chart, you can see the labor participation rate for all age groups other than the 65-plus-year-old have more or less recovered to its pre-pandemic levels. The shortage of labor has led to a surge in wages and contribute to the broadening of inflation. Wages are growing in all segments of the labor market. This contributes to cost-push price increases because wages are a large expense for many businesses. Higher wages in turn also imply that consumers can afford higher prices, potentially unleashing a wage price spiral that further fuels inflation. A declining supply of labor would impact the optimal policy response to combat high inflation or to boost economic growth. Here's what I mean. To combat high inflation, the standard playbook is to raise interest rates to reduce aggregate demand, which in turn will have a negative impact on employment. But when you have a shortage of labor, reduced demand will cancel out some of the need for labor and ease the labor shortage situation, while employment rate is still high. The impact is much less because most likely everyone is still fully employed. This gives the Fed more room to be aggressive on rate hikes. Remember the dual mandate of Fed: price stability and employment. If employment keeps looking good, then the priority is price stability. A declining supply of labor would also weaken the link between recession and unemployment rate, because recessions could arise simply from increasing retirements leading to less production. The standard playbook of cutting rates in recession would not make sense either, as the economy would remain in full employment. In fact, rates would have to be structurally higher to counter the inflationary impact of a steadily shrinking labor supply in an aging demographic society. I hope you find this information helpful. Please remember to subscribe to this channel for more insights and smash the like button. That's it for today. I will see you in my next video. Bye.